What a ride has been, in particular for Asia-Pac in November. You got to wonder whether gains are sustainable given that uncertainties remain.
Yeah, I mean, there's certainly a lot of uncertainties right now, but I think one of the key reasons why the Asia-Pacific stocks have had a great month is because of the weakening of the dollar. As you know, the inverse correlation between the dollar index and the Asia-Pacific stocks has always been very, very high. And this month, as you rightly pointed out, we've had a tremendous decline in the dollar index. In fact, it came off from like 114 to the current levels about 110. So I think that's one of the reasons why. And I think another reason is because obviously the market is also taking the stock, the recent measures by China, right, with relaxation of the COVID measures announced after the NPC. And even after last week, we haven't seen China actually impose the kind of Shanghai-style lockdowns that it had in February and March. And I think the markets are actually taking that positively.
Going into 2023, of course, we have a higher rate environment. What does it mean eventually for the economy? What does it mean eventually for markets? How much of that has been priced in already?
I think the first half will be very, very tricky because I think when we look at what's happening right now, especially in the US, valuations are actually pretty high, right? We're trading at close to about 18 times earnings when the 20-year historical average is about 15 times. Earnings growth will likely come under quite a lot of impact because of the fact that, the 475 basis points rate hikes that we had this year, I think the full impact of that will only be reflected in the first quarter of next year. And that will certainly feed into the corporate results in that sense. And I think that will certainly have an impact on sentiment as well.
You said earlier that Asia has benefited from the weaker dollar, but expectations are the dollar will remain quite strong, at least for the first half of next year. I mean, how will that play out then?
Yeah, well, the dollar will likely remain strong, but I think the dollar has more or less peaked out, and I think the market has actually started to price that in. In fact, the market is actually basically saying that, with the midterm elections coming through, and, now we basically have gridlock in Congress itself, that means that there'll be more impetus on monetary policy to actually try to stimulate a US economy that's likely to actually slow down quite dramatically next year. And that's one of the reasons why the market has actually pivoted towards a more dovish tilt in that sense. And that in turn is basically helping the situation.
Kelvin, let's have a look at your views on credit here. It's out of our MLive question here as well. In fact, MLive Pulse question, if you will. What is the biggest opportunity you see in the credit markets looking into 2023?
Well, I think the investment-grade credits are actually pretty good value right now. In fact, we do think that where the 10-year US Treasuries are concerned, they are probably likely to actually peak at about 4 to 4.1% thereabouts. So at that point in time, we don't think that there's likely to be more weakness where the Treasuries are concerned, and that in turn basically means that for the credits, especially for the investment-grade credits, we do think that the current yields are actually very, very attractive, and that perhaps you might want to actually start thinking about extending your duration to about 5 years to perhaps actually lock in those yields for at least the next 12 to 18 months.
And going back to what you were mentioning earlier about the dollar, if we see a dollar turnaround, how does that really affect the way that you have your investment ideas here? How do they change as a result?
Well, I mean, if the dollar continues to actually weaken, then obviously the emerging market bonds, the Asian equities, Asia ex-Japan equities, the Asian market bonds will actually suddenly be in a much better position to actually take advantage of that. If the dollar in turn actually strengthens, then obviously the upside for these bonds will actually be capped to a large extent, especially for Asian specific equities as well. Because again, the inverse correlation is actually pretty high because of the fact that a lot of Asian corporates actually issue bonds in US dollars. And so if the dollar strengthens, obviously the local debt obligations will certainly increase in that sense.
Kelvin, we're looking at, of course, at COVID and perhaps the lifting of COVID restrictions in China and how that could have a massive benefit for equities, which are, well, Chinese equities, and the prospects of that have lifted things very nicely here. The thing is, they also affect, for instance, Thailand, talking about that earlier, rate decision coming up later, not firing on all 4 cylinders because we don't have Chinese tourists there. So a lockdown removal in China affects, so should I say, provides relief for everybody, does it not?
Absolutely. I mean, if the Chinese authorities start to actually allow the citizens to actually travel out of the country again, then that certainly will be a huge boost to tourism in this region. And I think in Asia, it's basically Vietnam, Thailand, and Singapore that will actually benefit tremendously from the opening of the borders from China itself. Thailand, I think, is actually coming up from a very low base. Last year, you had only about 0.4 million tourists, compared to the pre-COVID numbers of about 40 million tourists a year. So, this year they're looking at the target of 10, but I think they're likely to actually hit about 12 million. And with the tourists coming in, you're starting to actually get a much better current account as well, because Thailand has always had a very high current account surplus as a percentage of GDP. That was affected to a large extent when tourism actually died last year. So with the coming of recovery of tourism, that will certainly help to boost the current accounts again.
So can Asia outperform the US and Europe? Can emerging markets outperform developed markets in 2023? I
certainly hope so, because I think Asia is trading at a huge discount to the US, right? I mean, if you look at MSCI China, MSCI China is actually trading at a 50+ % discount to the US. And that, I think, is the largest discount over the last decade or so. At some point, that discount actually has to close, right? And we do think that when the Chinese valuation is concerned, that will certainly creep up. And when the US valuations are concerned, that will certainly come off.
Japan? You're liking Japan.
Yeah, Japan is interesting because I think Japan, with the recovery in the economy, with the recovery in tourism coming into Japan. I'm going to Japan for a holiday at the end of the year. Like, I think 3/4 of Singaporeans as well. That will certainly help boost consumption in Japan. So I think to a certain extent, Japan is actually likely to actually benefit from that. And on top of that, the very weak yen this year will also likely boost corporate margins over the next 3 to 4 months.